SpaceX reported its first ever profit from artificial intelligence last week, $1,146 million. In the same quarter, on the same page of the same release, that segment lost $1,257 million from operations. This film is about the distance between those two numbers and why it is not a rounding error. The release leads with it. The segment reached positive adjusted earnings, against a loss of $276 million a year earlier. That was the quarter's evidence that the compute build has started to pay. It was read that way everywhere. So read the reconciliation printed directly underneath it. Start from the loss, $1,257 million. Add back depreciation and amortization, $1,885 million. Add back share-based compensation, $516 million. Add $2 million of restructuring. You land on $1,146 million. Exactly. There is no residual and no interpretation involved. The segment's entire adjusted profit is the depreciation on the assets its own capital spending is buying. Strip the depreciation alone, leave every other adjustment untouched, and that segment sits $739 million underwater. Underwater on the exact measure the release is celebrating. The market did not read it that way at all. The stock closed at $125.33 on the day of the release, $108.27 the day after, a fall of 13.6%. The reason given everywhere was capital expenditure, $10.1 billion in the first quarter, $18.4 billion in the second. $15.8 billion of that was artificial intelligence infrastructure alone. Now the obvious objection, because it arrives fast and because it is correct. Adding back depreciation is what this measure is. Every capital-intensive business on Earth shows a gap between an operating loss and adjusted earnings. Pointing at one is not analysis. Three things make this one worth the time anyway. The first is magnitude. The add-back is 1.6 times the profit it produces. So this is not a profit figure lightly adjusted for a non-cash item. It is a figure whose sign is decided by the adjustment. The second is direction. Depreciation in that segment grew 132% year over year. In the same quarter, the segment crossed zero. The add-back is outrunning the thing it is supposed to be a footnote to. The third is timing, and it is the one that decides this. Depreciation ran $811 million, then $1,493, then $1,885. Capital spending across those same 3 quarters ran $749 million, then $7.7 billion, then $15.8. Depreciation is chasing capital spending upward with a lag. Almost none of the $15.8 billion spent this quarter is in service yet, so almost none of its depreciation sits in that $1,885 million figure at all. The bill has been signed. It has not arrived. There is a second thing buried in these filings, and almost every outlet reported it backwards. One clause in the lockup releases 455.8 million shares early if the stock closes 30% above the offering price on 5 of 10 consecutive trading days. Everyone treated that as a live trigger sitting above the market. A rally arms it, the supply arrives, the recovery defeats itself. Read the clause. The 10 days end on, and include the earnings date. It looks backward, not forward. The window closed on the 4th of August. The test failed naught for 10. The best close inside it was 125.33, against a trigger of 175.50, 28.6% below. It was never in contention, and it can never be rearmed. Then, the market ran the experiment for us. On the 6th of August, 911.5 million shares became sellable in what several outlets called the largest lockup expiry in market history. The float more than doubled in a single session. The stock rose 6.14%. Eligibility is not sale. We all say that, and then we model unlock calendars as though it were. One live observation now sits against the reasoning almost everyone was using, and it is the biggest tranche of the whole schedule. The short side tells the same story from the other end. 219.3 million shares short, $24.6 billion, with utilization at 95%. It was float scarcity, not position size, that made the setup asymmetric. Tripling the float diluted it. And the balance sheet closes the affordability argument the coverage actually ran. $100 billion of cash and securities against $18.4 billion of quarterly spending. That is about 5.4 quarters, already funded before a single dollar of operating inflow. So here is what I am not saying. I am not saying the build fails. If the revenue attached to this asset base arrives on schedule, the add-back stops mattering, and the measure was simply early. That is the strongest argument against everything I have just said, and it deserves saying out loud. What I am saying is narrower. A segment was declared profitable for the first time on a measure that structurally cannot see the spending which defines it. In the quarter, that spending grew 21 times. The measure did not lie. It was asked a question it cannot answer. One line in the next release settles all of it. Segment depreciation against segment adjusted earnings. While the first is larger than the second, the milestone announced on the 4th of August has not happened yet. Everything here is read from the 8K, the 10Q, and the prospectus. Nothing is modeled, and nothing is estimated.